A number of Kenyan banks have released their 2021 financials detailing their performance a year after the COVID pandemic impacted the industry. We take a look at 6 of them: Stanbic IBTC, Standard Chartered Bank, Absa Bank Kenya, Cooperative Bank, KCB Group, and the Equity Group as well. Joining us to review the Kenyan bank sector is Ronak Gadhia, who's a Chartered Financial Analyst and Director of Sub-Saharan African Banks at EFG Hermes Research. Good morning to you, Ronak. Thank you so much for joining us. I guess we can start with Stanbic IBTC results. I guess the fall in customer deposits year on year when other banks saw an increase. What do you make of their result there?
Good morning, and thanks for having me. Look, on Stanbic's deposits, I think there's a bit of a confusion because of the way the bank reports its deposits. It includes interbank deposits and customer deposits. So aggregate, it's declined. But if you just look at the customer deposits specifically, it actually increased by around 10% or slightly more than 10% on a year-on-year basis, which is very much in line with what we were seeing at the other banks. As we know from the bank, it has been implementing its retail and digital strategy over the last 3 to 4 years, and it continues to do so. And going forward, as a result of that, I think the deposit growth should continue to remain fairly robust.
And as far as the rest of the results that Stanbic reported, does that show a recovery? What do you make of the overall results for the bank?
Overall, quite positive. As I mentioned, we saw some relatively robust growth on the balance sheet. At the same time, the initiatives the bank took from a digitization side, growing its presence on the retail side, we're seeing increased growth on the fees and commission income as well. And then finally, from asset quality perspective, also we saw an improvement on a year-on-year basis as the bank's asset quality continues to recover from the deterioration of due to COVID-19. Rather.
Thank you so much for that. All right, let's move to Standard Chartered Bank. Their results, I guess, also double-digit growth, but I think there was a decline in net interest income. Other banks saw an increase. What do you think was behind that?
I just think there's an element of Standard Chartered being a bit conservative on that side. If you look at the balance sheet growth relative to its peers, it was relatively modest in the low single digits. That seems to indicate that management are being conservative in a difficult operating environment. At the same time, if you look at lending rates or rather interest rates, because of the reduction in interest rates by the CBK in 2000, we were seeing an impact of that come through as well. So the combination of low single-digit balance sheet growth combined with slightly lower rates meant that net interest income was a bit more under pressure compared to other banks. But overall, like you mentioned, we saw a big increase in profits, and that I just really is a reflection of significant improvement in their asset quality and cost of risk ratios.
Okay, excellent. Let's move to Absa Bank. Anything notable in their earnings release for Absa Bank?
Yes. So if you look at their numbers, their balance sheet growth was sort of in the low teens, which is a slight acceleration from what we've seen over the last 10 or so years. I think what that tells me is that Absa, following the rebranding from Barclays, which was completed last year, is now starting to get a bit more aggressive in the Kenyan market. If you look at Barclays, Absa before it rebranded, before the rebranding, since the global financial crisis, the growth rate in Kenya has been pretty modest because the Barclays PLC had issues at the PLC level following the financial crisis, and then they had various other issues as well. So given the uptick in growth that we're seeing in 2021, it seems to suggest that maybe Absa would be a bit more aggressive on the Kenyan market going forward compared to where Barclays was.
Okay, excellent. So I also want to get your take on Cooperative Bank as well. Also, their financials showing healthy growth for fiscal year 2021. Anything notable for Cooperative Bank's numbers?
Yeah, I mean, look, the key there, we saw positive improvement across most profit drivers, but what really caught my eye was that their cost-to-income ratio and OPEX, OPEX on a year-on-year basis was flat. which means management did a pretty good job of containing costs in a year where inflation was anywhere between 5 to 6%. And as a result of that, we've seen the cost to income ratio drop quite significantly on a year-on-year basis. And from what management are saying, we should expect more of that going forward. The other notable for them, and this is a bit of a theme across the Kenyan banking sector, is the NPLs. Again, we saw an improvement from Coop on their NPLs, but their absolute NPL ratio is still around 14%, which is still relatively high and somewhat, I would say, disappointing in my opinion.
All right, thanks for that. To KCB Group, looking at their asset size, KCB Group looks like I think a juggernaut. I think it's $1 trillion shillings, so 1.1 trillion shillings, 15% growth. How do you assess the performance of KCB Group?
I'd say positive as well. Again, we saw, as we've seen with KCB over the last 5 or 6 years, they have a strong cost focus, and that continues to come through. And as a result of that, we saw further improvement in cost to income ratio. On the non-interest revenue side, given the initiatives on the digitalization, plus the growth in the mobile loans portfolio, we saw some decent growth in their non-interest revenue side as well. And from a balance sheet perspective, we saw growth of around 12-13%, which again is a notable acceleration from the last 2-3 years, which partly is driven by the acquisition of the subsidiary in Rwanda. But even on an organic basis, we did see an uptick in growth, which is promising. But like I mentioned for Coop as well, from an NPLs perspective, the performance was slightly disappointing as we saw the NPL ratio increase quite significantly in the fourth quarter, and currently the NPL ratio is around 16%, which is slightly disappointing.
Oh, wow. So Absa Bank, 14% NPLs, KCB, 16%. So NPLs is, I guess, non-performing loans to our viewers, a concern. Equity Group, that's another, large bank as far as asset size is concerned. What do you make of the results, and how are these larger banks maneuvering compared to the smaller competitors?
Well, firstly, just to correct, Absa's NPL ratio is not at 14%. It's Coop. I think Absa's is slightly less than that.
Coop, thank you. Thank you for that correction.
Sure. But as far as Equity Bank is concerned, look, a very, very strong set of results. As per our discussions, the key theme for the Kenyan banks has been on the NPLs. On that front, Equity did very, very well. Their NPL ratio declined to 8%. Which was a notable improvement. Management indicated that they made significant efforts in terms of recoveries. So that was quite positive. And on the back of that, we saw the cost of risk dropping to around 0.8%, which is very good. But apart from that, like you rightly mentioned, we're seeing some pretty, the balance sheet become quite sizable. For Equity Bank, we over the last 4 or 5 years, we have seen some very strong growth from their regional subsidiaries. That continued to be the case. We saw some very strong growth coming from Tanzania, Rwanda, Uganda, and specifically DRC. If you look at the DRC balance sheet now, on a standalone basis, Equity Bank DRC would be the 9th largest bank across East and Central Africa, which is quite phenomenal. But apart from the regional subsidiaries, what we have seen at Equity over the last 18 months is growth within the Kenyan subsidiary also accelerate. Last year, the assets and loan book for the Kenyan subsidiary grew by more than 20%, which is quite noteworthy given that it's significantly above what their peers were reporting. So overall, very strong set of results from Equity, and from what management are indicating, it seems that momentum should continue this year.
All right. So looking at overall these 6 banks collectively, would you say 2021 was a recovery year? How would you assess everything holistically?
Well, look, strong growth in earnings on a year-on-year basis, and recovery was one of the themes. As I've consistently mentioned, on a year-on-year basis, we did see a significant decline in cost of risk across all the 6 banks. So that was one of the key drivers. But I think it would be a mistake just to attribute the earnings growth to decline in cost of risk or recovery in NPLs. I think even if you look at the operating performance, with the exception of maybe Standard Chartered, all the other banks were reporting operating revenue growth in excess of 10%, Equity in excess of 20% as well. And as I mentioned, when you look at the guidance from these banks, it seems like that momentum should continue into this year. So it's more of recovery as well as acceleration in growth, in balance sheet growth as well, coming through.
Excellent stuff. Really, thank you for the deep dive. Ronak Gadhia, CFA, Director of Sub-Saharan African Banks at EFG Hermes Research. Thank you so much for your time. We appreciate it.